You ever think about a massive company, like a Disney or an Alphabet? Well, they're not just one single thing. They're actually more like a huge family of smaller companies. But when it's time to show the world what they're worth, they can't just hand out a bunch of separate snapshots. Nope, they need one big, official family portrait. And today, we're going to figure out exactly how they take that financial photo.
So that really leads us to the big question, right? How do you measure the true size of one of these corporate giants? I mean, if you only look at the parent company, you're missing a massive piece of the puzzle, all the other companies it owns. So how do we get the whole picture all at once?
Okay, let's meet our little corporate family for today. On the left, we've got Company P. That's our parent. And on the right, Company S, the subsidiary that P owns. Now, you can see they each have their own separate financial statements, but look closely on the left, under P's assets. See that line? Investment in S? That's the link. Just looking at these two side by side doesn't really tell us the combined power of the family, does it?
So here's the game plan. We're going to start with this whole family portrait idea, then we'll see why just adding things up is a big mistake. After that, we'll tackle two really important puzzles, something called goodwill and the problem of selling stuff to yourself. And finally, we'll put it all together to see the group's real value.
So, first off, why even bother with all this? Well, the whole point of a consolidated statement is to show the parent company and all its subsidiaries as if they were one single, unified business. It's about showing all the resources the parent truly controls.
And here's the core principle, the #1 rule of the game. You take all the assets and all the liabilities from both the parent and the subsidiary and you smoosh them together. But, and this is so important, you have to exclude any deals made between them. Think about it. You can't owe yourself money, right? It just wouldn't make sense.
All right, so your first thought might be, okay, this is easy. Let's just add up every single line from P and S. I mean, it seems logical, but it actually creates a couple of pretty big problems for us.
And this is what that looks like. At first glance, it seems okay. But wait, hold on a second. See that investment in S from the parent company? It's still there. And so is the subsidiary's own share capital. We're basically counting the same value twice. That's a huge no-no. It completely misrepresents the group's finances. We need to do some adjustments.
And this is where our special toolkit comes in. This chart shows what we call consolidation workings. Think of these as the special calculations we have to do to get from those two messy, separate statements to one clean, accurate group picture. We're going to focus on two of the big ones, goodwill and something called unrealized profits.
So let's tackle our first puzzle. When a parent company buys a subsidiary, it almost always pays more than what the subsidiary's assets are worth on paper. Why? Well, they're paying for its reputation, its brand, its loyal customers. And in the world of accounting, that extra premium you pay gets a special name: goodwill.
So, what's the official definition? Well, it sounds complicated, but goodwill is basically an asset you can't touch. It represents all the fantastic things about a company that you can't just put a price tag on, you know? Like a super strong brand name or an amazing team. It's the value above and beyond the physical stuff. And how do we figure it out? It's actually a pretty simple three-step process. First, you look at what the parent paid for the subsidiary. Second, you figure out the actual value of the subsidiary's net assets, so its assets minus its liabilities. And the difference, that gap between what was paid and what the company was worth on paper, boom, that's your goodwill.
And really, this gets right to the heart of it. A company isn't just buying buildings and machines. It's buying potential. You're paying extra because you believe that company's reputation and its customer base are going to make you way more money in the future than its physical assets alone ever could.
All right, on to our second puzzle. What happens when companies inside the same corporate family sell stuff to each other? Let's say the parent makes a widget and sells it to its subsidiary for a profit. Has the group as a whole actually made any money yet?
This little example with Pineapple and Satsuma nails it. So, Pineapple buys some goods for $400. Then it sells them to its own subsidiary, Satsuma, for $500. Pineapple writes down a $100 profit, but from the group's perspective, did a real sale happen? Nope. The goods just moved from one warehouse to another within the same big family. That profit isn't real until Satsuma sells those goods to somebody on the outside.
So here's why this matters. If we don't adjust for this, two bad things happen. The group's inventory is valued too high, and its profit is artificially pumped up. We have to make an adjustment to get rid of this unrealized profit. That way, the inventory is shown at what it really cost the group,
and the profit only reflects actual money coming in from the outside world. Okay, let's bring it all home. After we've figured out our goodwill and stripped out any of those unrealized profits, we can finally build the real consolidated statement of financial position. This is the true family portrait.
And here it is, the final picture after all our hard work. Notice what's different from that simple addition we did at the start. The parent's investment in S? Gone. The subsidiary's share capital? Vanished. Instead, we have a clean, combined total for assets and liabilities that tells one single cohesive story about the entire group. This is the real financial health of the company.
So let's quickly recap what we've learned. A consolidated statement is all about showing the full, complete picture of a corporate family. We do that by combining the parent and subsidiary, but we have to cancel out that initial investment to stop from counting things twice. And, crucially, we have to make those special adjustments for things like goodwill and get rid of any imaginary profits from sales made inside the family.
So now that you know the secrets behind how this corporate family portrait gets made, it leaves you with a pretty interesting question. The next time you look at the financial report for a huge company, think about the story behind those numbers. What companies did they buy to create that goodwill? What kind of internal deals had to be canceled out to get to the final number? What other stories are hiding inside their consolidated reports?